Ladies and gentlemen, Archivist speaking. If you want to understand the real timeline of the coming global conflict, stop watching aircraft carriers drifting through the Taiwan Strait. Military hardware is a distraction. Carriers can be deployed for drills, paraded for signaling, and quietly recalled within days. They exist to be seen. They are theater. If you want to understand intent, real, irreversible intent, you must track something far heavier, far slower, and far more revealing. You must follow sovereign debt. Debt is the foundation of the global order. It doesn't move quickly. It can't be hidden easily. Large positions take months or years to unwind without detonating markets. When a superpower begins dumping another superpower's debt at a pace that defies financial logic, that is not portfolio management. That is preparation. Today, we conduct a forensic deep dive into one of the most boring, misunderstood, and critical documents in global finance, the U.S. Treasury's TIC report. Most analysts glance at the headline and move on. We are going into the footnotes, because that's where intent lives. The data released this week confirms what Wall Street has spent the last year denying. China's official holdings of U.S. Treasuries have collapsed to $688 billion as of October 2025. To the untrained ear, $688 billion sounds enormous. In reality, it represents a financial rupture. This is the lowest level of Chinese ownership since May 2009. 16 years of financial integration have been erased. At the peak of the so-called Chimerica era, in 2013, Beijing held $1.32 trillion U.S. debt. China effectively financed America's deficits. The U.S. bought cheap Chinese goods. China recycled the dollars back into treasuries, and global interest rates stayed artificially low. That loop is gone. China has liquidated nearly 48% of its peak treasury position, over $600 billion dumped. But the size of the sell-off isn't the most disturbing part. The timing is. Throughout late 2024 and all of 2025, the U.S. bond market experienced one of the worst drawdowns in modern history. Yields spiked. Prices collapsed. Anyone selling treasuries during this window was locking in losses. In asset management, you do not sell a depreciated asset at a loss unless one of two things is true. You need emergency liquidity, or you believe the asset is about to become dangerous. China is not short on cash. Despite property sector chaos, it continues to run massive trade surpluses. Liquidity is not the issue, which leaves only one conclusion. Beijing has decided that U.S. Treasuries are no longer a store of value. They are a strategic liability. This realization was forged in February 2022, when Russia invaded Ukraine. Within days, the U.S. and EU froze $300 billion of Russian central bank reserves. Funds Moscow believed were untouchable. They were immobilized instantly with a few keystrokes. Beijing watched this carefully, and they understood something terrifying. In a Taiwan or South China Sea conflict, Chinese treasury holdings wouldn't protect them. They would be hostages. That remaining $688 billion is not an asset. It is pre-seized collateral waiting for sanctions. So China is exiting. They are willing to take a 10 to 20% haircut today to avoid 100% loss tomorrow. This is not rebalancing. It is a burn notice. Normally, central banks hide their selling to avoid spooking markets, small tranches, slow exits. But China dumped nearly $12 billion October alone. That speed tells us everything. They are no longer prioritizing market stability. They want capital out of U.S. jurisdiction. Now, this creates a seismic problem for the United States. For 2 decades, America could run trillion-dollar deficits because China was a price-insensitive buyer. Yield didn't matter. They needed to recycle trade surpluses. That buyer has flipped. China is no longer the backstop. So who is buying the debt? This is where the story turns darker. As China exits, the allies are being forced to step in. The TIC data shows abnormal surges from the United Kingdom and Belgium. The UK now holds over $750 billion U.S. Treasuries, rivaling China. Let that sink in. The UK economy is a fraction of China's size. Britain runs a trade deficit. It does not generate excess dollars. So where is the money coming from? Leverage, financial engineering. London acting as a shock absorber for Washington. Then there's Belgium. Belgium's holdings now sit between $320 to $370 billion. Belgium is not rich, but Belgium hosts Euroclear, the plumbing of global finance. When Belgium buys treasuries, it's usually acting as a custodial proxy for other central banks trying to mask activity. The timing is unmistakable. China sells, UK and Belgium spike. This is coordination. This is the bag-holder alliance. Washington is effectively telling its partners, if you don't absorb this supply, the Treasury market breaks. If the Treasury market breaks, the global system collapses, and we can't protect you. This is financial conscription, but it has a fatal flaw: capacity. China had real capacity because it produced real goods. The UK and Europe don't. They're already debt-laden, slow-growing, energy-constrained. By forcing allies to absorb US debt, Washington is draining its own periphery to save the core. This system is fragile. If Britain stumbles, like during the 2022 LDI crisis, it will be forced to sell treasuries to survive. If that happens, the bid vanishes. China understands this. This is attrition warfare. Every billion China sells forces the West to sacrifice $1 billion of liquidity. Capital is diverted from factories and infrastructure into refinancing American debt. While the West shuffles paper claims, China is converting dollars into physical reality. Where is the money going? Follow the ships. Gold. China has been buying relentlessly, officially for over 18 months, and officially far more via Shanghai withdrawals. Gold has no counterparty risk, no sanctions, no freeze button. Energy. China imports 70% of its oil. To counter a Malacca blockade, it is filling its strategic reserves at record speed, approaching 1.5 billion barrels. This oil is survival. Metals. Despite a collapsing property sector, China imported approximately 28 million tons of copper in 2024. Why? Because copper is war infrastructure. Grids, drones, EVs, weapons, food. China controls 60 to 70% of global grain reserves. Calories matter more than yield. This is the shift. Peace economies hold interest-bearing paper. War economies hold inefficient stockpiles. China is accepting negative financial yield in exchange for strategic survival. Western economists laugh. They sold at the bottom. Wrong framework. China is trading paper wealth that can be frozen for physical wealth that can't. The Treasury market is no longer risk-free. It is a battlefield. So what do? Protocol 1. Avoid long-duration bonds. TLT is vulnerable. Duration kills in rising rate regimes. Protocol 2. Short-term liquidity. T-bills, not 30-year promises. Protocol 3. Follow China into commodities. Energy. Metals, gold, producers, not paper. Protocol 4. Watch the allies. GBP. JPY. If Japan is forced to sell to defend the yen, the system cracks. The $688 billion figure is not a statistic. It is a countdown. China is clearing the decks. The stability you see is artificial. When it breaks, it will break violently. The divorce is done. We're just waiting for the house to be sold. Archivist out. The protocol is active.